What is a good return on equity for value investing? Imagine finding a company that uses its shareholders' money so well that it keeps making solid profits year after year. That's what return on equity measures. It shows how effectively a company turns shareholders' investments into earnings. For value investors, a good return on equity is usually around 15% or higher. This means the company is generating $15 or more in profit for every $100 of shareholders' equity. Why does this matter? Because a high return on equity suggests the company is good at using its resources to make money. It often indicates strong management and a competitive edge in its industry. When you see a company with a return on equity above 15%, it can be a sign that the stock is undervalued and has long-term growth potential. But don't just look at the number alone. Industry differences matter a lot. For example, technology companies tend to have higher return on equity than utilities because they need less capital to operate. Comparing a company's return on equity to its industry average gives a clearer picture of its performance. Also, check if the return on equity stays steady over time. A one-time spike might be due to unusual events or accounting tricks. Consistent high returns over several years show the company can keep up its performance. Be cautious if a very high return on equity comes with high debt levels. Sometimes companies borrow a lot to boost profits, which can be risky. It's important to analyze if the earnings are genuine or if they come from financial leverage. For long-term investment plans, focusing on companies with stable or growing return on equity above 15% aligns well with value investing principles. These companies tend to generate profits efficiently and could see their stock prices rise as the market recognizes their true worth. Remember, combining return on equity with other key metrics like low price-to-earnings ratios, strong cash flow, and manageable debt creates a stronger investment case. This approach helps build a solid, long-term strategy for adults looking to grow their wealth steadily. In short, a good return on equity for value investing is generally around 15% or more. It shows the company is using its shareholders' money wisely to generate profits. But always compare it to industry norms, check for consistency over time, and consider the overall financial health before making your investment decisions.